And same thing with Korea. They had these memory companies that went crazy, and now it trades at almost 4 times GDP. Just stupid. Now, down 20% in the last 5 days, probably going to go down a lot more. Does all of that trigger a 1929-esque collapse this fall in the US? Certainly possible. I mean, it's kind of ironic that the book 1929 came out earlier this year or late last year. It is interesting. There is this 90-plus year cycle that tends to repeat itself, but ultimately those things are going to collapse. As that equity leaves, I do think some will find its way into Bitcoin and gold and other stores of value.
History rarely announces itself before it repeats. It whispers through soaring valuations, impossible optimism, and a widespread belief that this time is somehow different. In the late 1920s, investors became convinced that a new era of technology and prosperity had permanently changed the rules of finance. Stocks detached from reality, speculation reached a fever pitch, and leverage fueled a rally that seemed unstoppable until it wasn't. What followed became one of the most devastating financial collapses in modern history. Nearly a century later, another technological revolution has captured the world's imagination. Artificial intelligence has created trillion-dollar narratives almost overnight. Private companies are commanding valuations once reserved for entire industries. Investors are pouring billions into anything remotely connected to AI, while markets continue rewarding growth with little regard for traditional valuation metrics. To many, it's the dawn of a new economic age. But to others, it's beginning to resemble the final stages of an increasingly dangerous bubble. If that optimism suddenly evaporates, the consequences could stretch far beyond technology stocks. Global equities could experience a sharp repricing, liquidity could dry up, and risk assets including Bitcoin might initially get caught in the panic. But according to veteran investor Mark Yusko, that first reaction may not tell the whole story. In fact, he believes the very event that frightens investors the most could eventually become one of Bitcoin's biggest catalysts. Today, we'll examine why Yusko believes Bitcoin remains fundamentally undervalued despite recent weakness, why he thinks a rotation out of massively overvalued AI companies could send capital into Bitcoin and gold, and why the next phase of this market cycle may look very different from previous ones. If you enjoy deep macro analysis that goes beyond the daily headlines, don't forget to like this video, subscribe to the channel, turn on post notifications so you never miss an upload. Now, let's hear what Mark Yusko has to say.
As I understand it, and I haven't talked to Tim Peterson is the guy that does the model that I like the most. I mean, there are a number of people who calculate Metcalfe's law values for Bitcoin, but what I like about Tim Peterson's model is his decay factor in the model is a little higher. Because if you think about a network, right? Think about your friend network. There are people you knew when you were young who you kept in touch with for a while, and then they kind of fade out of your network and they get replaced with new people. And then those people fade, and so networks change. And the number of people that leave a network, the decay rate, has to be positive. A lot of the early Metcalfe's law said, oh, there'd be no decay. Once a person becomes a Bitcoiner, they're going to be a Bitcoiner forever. Maybe, but not necessarily. You know, people pass away, people change their mind. So long story short, I think Tim's model today says Metcalfe's value is somewhere still like 105, 108, something like that. Significantly higher than where we are today. Now, why would that be? Well, we talked about this. The 4-year cycle, which a lot of people tried to say was dead and that institutionalization was going to get rid of it. I'm like, no, humans are going to human. And humans are going to follow this pattern because the 4-year cycle is baked into the code. It's hard-coded into Bitcoin. Maybe say, Mark, what are you talking about? Well, every 4 years, we have the block rewards. So we cut the number of rewards in half. So in theory, if the miners who are mining to protect the network, to secure the network, if suddenly their revenues get cut in half, some of them would go out of business. Well, what's their incentive then? Then their incentive is to not to sell the Bitcoin until the price rises so they can cover their costs. And so there's a natural movement that's incentivized by the halving for the price to rise. Well, when something starts moving, when the price starts rising, that attracts attention. And that attention pushes the price even further. And then at some point, it gets to the speculators and the gamblers, and they come in with leverage, and we get the price to go way above fair value. And that's where we were last October, is we were way above fair value. And unfortunately, then humans are going to human. They're going to panic. They're going to sell. The speculators on the other side come in and short, and they push the price back below fair value. And the people that don't have conviction, meaning they don't either understand the fair value of the asset, or they don't know, why they're in the asset, they just bought it because it was moving, they lose conviction and they sell. And that pushes the price well below fair value following this cycle. So we go into crypto winter, where we are today. So TikTok next block, the blockchain just keeps moving along. The network keeps growing. The number of participants, the number of transactions, the dollar volume of transactions, that'll just keeps going up. The hash rate just keeps going up. But unfortunately, that, Metcalfe's law of value is the anchor to windward, but the price tends to move in a sine wave, higher and lower, overvalued, undervalued. So when we crashed back through 90K last fall, and we went into this big sell-off in February, going down to the lows of, 60K, people were in panic mode. Now, what's nice is in the previous cycles, we went down 84%, 83%, and 74%. This time we went down around 51%. So people are saying, well, it's going to go down more by October. And sometime around October 5th or 4th, we should be done with this part of winter. And then we start going back up. The number of Bitcoin owned by whales is rising again because they are the buyers of last resort. They're the long-term hodlers, the long-term investors. Investors, I consider myself in this category. I love to buy two types of things. I like to buy something below fair value. That's how I really like to do it, because I'm a value guy. But I will also buy something close to fair value if I think it's growing really fast. So some of the computing companies and the like would fall into that category. But I tend to be a value person. So when Bitcoin today is trading well below Metcalfe's law of value, we start accumulating. So we've been buying a little bit every week since February, and we'll continue to do that, probably through October or so. And then we'll enjoy the ride on the other side.
Yusko's argument ultimately comes down to separating price from value. While short-term sentiment continues to swing between fear and euphoria, he believes Bitcoin's underlying network keeps expanding regardless of market cycles. According to his framework, every major sell-off eventually creates opportunities for long-term investors willing to focus on fundamentals instead of emotion. The volatility may be uncomfortable, but in his view, it's simply part of Bitcoin's natural rhythm. That brings us to the bigger macro question. If Bitcoin is trading below what Yusko considers fair value, where has all the capital gone instead? His answer points directly toward the explosive AI boom. From semiconductor giants to private technology companies commanding extraordinary valuations. He believes speculative money has piled into a handful of assets that have become increasingly detached from reality, and if those trades begin to unwind, the destination for that capital could reshape the next chapter of the crypto market.
I do think there's capital that has rotated into speculative equities and debt. Look at Kospi and the Taiwanese stock market, right? Taiwan is a little tiny island that doesn't even have that many people, and its stock market was like the 6th largest in the world. I mean, it's just silly because they have one big company that makes all the semiconductors. And same thing with Korea. They have these memory companies that went crazy, and now it trades it at almost 4 times GDP. Just stupid. Now, it's down 20% in the last 5 days, probably going to go down a lot more. Does all of that trigger a 1929-esque collapse this fall in the U.S.? Certainly possible. I mean, it's kind of ironic that the book 1929 came out earlier this year or late last year. It is interesting. There is this 90+ year cycle that tends to repeat itself. Certainly possible. I'm not calling for a big crash, but it's the level of valuation in the AI companies like Anthropic and OpenAI and then things like SpaceX that are like the valuation of SpaceX today relative to its earnings power and earnings growth and revenues there's no other word for it. It's silly, right? It's actually stupid. It's beyond silly. It's stupid. Doesn't mean it can't stay that way for a while, but ultimately those things are going to collapse. As that equity leaves, I do think some will find its way into Bitcoin and gold and other stores of value. I could see a pretty meaningful switch in the fourth quarter. Let's say a September, October adjustment happens in global equity markets. I'm not saying it will happen, but let's just say for thought experiment that it does. That would create trillions of dollars of losses and would pressure some portion of that capital before it gets lost into safe havens. That could trigger a pretty meaningful rally in Bitcoin prices. I think less so in the other alts markets, but definitely in Bitcoin, maybe Ethereum, but really Bitcoin. I do think that's reasonably likely, actually. And that'll be the start of crypto spring. But remember, crypto spring doesn't mean straight up. Spring is like this. It's kind of wavy and choppy, and there's a little bit of upward trajectory, but not a lot. Then we get into summer the next year, and that's pre-halving, election, all kinds of questions. So you get a lot more volatility, still an upward drift, but it's really that third year or the post-halving year that we get the big rally. And that's when, I think we could see 29, we could see big numbers again.
Yeah, because the next halving, I think it's scheduled for 2028, I think. Regarding this scenario where we're going to see a crash in tech stocks and essentially this bubble that is going to burst, there is a lot of talking about a bubble that is poised to burst at a certain point. That, in my opinion, would probably cause a massive crash also in Bitcoin and crypto, essentially, because that's how these assets have been always behaving. So when there is a big crash...
So okay, and it's a really important point. The subtle difference is historically the adjustment in pricing in equities, whether it was the COVID lockdowns or the recession a couple of years ago, those were during periods where there was a lot of speculative excess in the crypto markets. This time we've washed all that out. The amount of leverage in the crypto markets is actually very low right now. So I'll argue, I could be wrong, but I'll argue that you won't see the same adjustment downward in crypto as you normally would, because you're not unwinding these silly speculative excesses. That's already been unwound. From October to February, that's when the bad amount of leverage was unwound. Now we just don't have that much leverage. Could you drop another 10 or 15, 20%? Sure, anything's possible. But I'm going to go with, if it's really like a 2000 or a 29 or a 73, what you saw in those periods was the safe havens gapped up and gapped up a lot. Gold in particular, we didn't have Bitcoin back then, but that's what I think is more likely.
Whether or not a crash on the scale of 1929 actually unfolds remains impossible to predict, and even Mark Yusko is careful not to present it as a certainty. His central argument is far more nuanced. Markets move in cycles, speculation eventually reaches extremes, and when capital begins searching for value again, assets with stronger long-term fundamentals often become the biggest beneficiaries. In his view, Bitcoin is positioning itself to be one of those assets. That doesn't necessarily mean investors should expect a straight line higher. As Yusko points out, every new phase of the crypto cycle brings volatility, uncertainty, and periods where conviction is tested. Even if Bitcoin ultimately outperforms, there could still be sharp corrections along the way as global markets digest whatever comes next. The path forward is unlikely to be smooth, but long-term trends rarely are. Perhaps the most important takeaway is that Yusko isn't simply looking at price charts. He's looking at capital flows, network growth, investor psychology, and valuation. While much of Wall Street remains captivated by the AI narrative, he's asking a different question: what happens when expectations become impossible to meet? If speculative excess begins to unwind, the search for durable stores of value could become one of the defining investment themes of the coming years. Of course, no forecast is guaranteed to play out exactly as expected, and every investor should do their own research before making financial decisions. But whether you agree with Yusko or not, his perspective offers an important reminder that today's most popular trade isn't always tomorrow's biggest winner. If you enjoyed this analysis, make sure to leave a like, subscribe to the channel, share this video with anyone following Bitcoin and the broader markets, and let us know your thoughts in the comments below. Do you think the AI boom is becoming a dangerous bubble, or is this just the beginning? Thanks for watching, and we'll see you in the next video.